Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. You are listening to Money on Tap. My name's Seth Krussman.
And I'm Ben Brayshaw.
Today, you guys, there is so much going on right now. Besides our phone number, which is the same, 855-226-8551, or you can reach us at info@yourmoneyontap.com. The landscape around us is moving, folks. It is moving.
It is, Seth. We've got a great show. I'm super excited about this show today. I know I say that a lot, and but I think that's what gets us going every time we get on the radio. So, understanding the market, what small, mid, and large cap means to your portfolio. Seth, I am excited to dive right into what this is. There's so many people who are saying, "Hey, I invest. I'm trying to understand what I'm buying." I made a presentation to a group of people. It was actually live. It was not. It was a live presentation this last month, and there was a lot of conversation around, what am I investing in when I buy this stuff, and what does it mean to your portfolio? And I think this is going to be a very helpful show for a lot of our listeners.
Yeah, I mean, we could continue to just go, but before we do, let's go ahead. Let's take a minute for you to bring you Money in the News.
So first up today for Money in the News, we have Amazon. Amazon has never made Money in the News before for us, right, Seth? No, it seems like every other week we're in Amazon. But Amazon has literally launched their pharma business. Now, Amazon, to have their own pharmacy ready to go with Amazon Prime is a big deal. It's been talked about since 2017, and everyone has known they have been working on this for quite a while. This is a big deal. It's such a big deal that the day they announced it, CVS dropped almost 9% in their stock price.
Yeah, they were on a tear, too. I was just watching that thing climb, and off of the cliff it went.
Yeah, and I'm an investor in CVS, have been, own it. And there's a number of different pharma companies out there. Walgreens is one as well. And there's different plays to all of this and how this is all going to transpire. Now, CVS, they bought Aetna, and there's a lot of other pieces around CVS that's not just the pharma piece, which is interesting, but it really impacted their stock hughtely. Just crazy.
On the flip side of that, though, if you take a look at the chart on Amazon right now, not a whole lot moving. And it's an interesting correlation that, CVS and Walgreens just fall off the cliff, but Amazon just kind of hanging out, not doing a whole lot. And like you said, it's been in the works for a long time. We've actually, believe it or not, we've talked about this in Money in the News. And I think the next time that we talk about Amazon, we're going to, they're going to be retailing cars and trucks and delivering to your house.
Test drives.
Everything.
We're going to drop a test drive in 2 days. Amazon Prime. It's a big deal, and this is a huge piece. I mean, this industry is a $300 billion industry. And when we talk about the number of people in America who need drugs every day to live, for blood pressure, insulin, you name it, the simple everyday prescriptions that people use, the thing that we don't take into account is it's a $300 billion industry today, but we still have 85 million Americans to retire from the baby boomer in the next 20 years. And we all know as you get older, you don't need less drugs, you usually need more. And I think this industry is it's climbing and climbing and climbing. I feel
like you could apply that to 2020. In the year 2020, you don't need less drugs. You just need more.
I would say there's a lot of people out there listening that would probably agree with you right now, Seth. But
calling my doctor right now.
Yes. So there's a lot going on in 2020 here, but this is a really major breakthrough. So
much fun to talk about Amazon anytime that we get a chance. But next up, folks, did you know that there's a new trade deal out there? It's the Asia Pacific trade deal with 15 countries that have signed up. This has been in the works for like over 10 years. And China really is leading the whole thing here. And what is it going to do? It is going to lower tariffs. It is going to really change the landscape for these countries, which wind up being about a third of the world's population, and opening up those doors. So there's going to be a lot more movement from goods and services around that part of the globe. And that includes Japan, South Korea, Australia, Singapore, Vietnam, Indonesia, just to name a few. Who's not in? India. That would have been a big one as well. But they really felt that there was going to be a lot of imports coming in, and they really wanted to support their economy by trying to lessen the imports and stay consolidated within themselves. And that's an idea that, it's not unfamiliar. And especially with the pandemic, it's very common that a lot of these countries are focusing on trade with themselves. So it's an attempt to really start to alleviate. I think one of the big pushes right now is to alleviate some of that tension, create more flow, and more dollars getting around the horn. And it's certainly going to work out well for Beijing.
Absolutely. It sure does. And then I think India was not participating, and they're hoping that they will at some point in time. So
also, what's our policy going to be moving forward? Because it's been fairly restrictive with China.
Yeah, it has, and it's a lot of it has to do with who becomes president, right? And that's a complicated conversation to begin with, especially as we hear states not willing or counties not willing to ratify their votes, which is bizarre, and a strange amount of happenings coming on our way. But that's not part of our article story today. Okay. The next one, Seth's looking at me. Seth's like, is there another article I don't know where? Listen, we're going to talk about vaccines here for a second. So the Wall Street Journal came out with an article on Pfizer says their vaccine is 95% effective in final data, which is right where Moderna was. They were 94.5%. And these companies are coming out left and right. And we still have, it's J&J and AstraZeneca and Novavax, all expected. They're all in phase 3 testing as well. They're all looking to launch their vaccine. This is obviously a highly contentious conversation as well. I mean, it seems like we get all the good ones. What's interesting about this vaccine, and they talk about this in the article that Jared Hopkins wrote, was the difference between traditional vaccines and how messenger RNA vaccines work. It's funny how they talk about messenger RNA vaccines when this is the only messenger RNA vaccine that has ever happened. It's kind of interesting. They act as if it's a standard, but this is a very, very.
And you have a personal experience around this. It's really is foreign news to me. I don't really quite get the impact of what this all means, and it's a bigger conversation. But please, yes, keep going.
Yeah, no. So as Seth is correct, I am a vax-injured person. So when I was in college, I ended up having a number of vaccine shots to catch up as I was studying to be a doctor, actually. And what ended up happening was I had to catch up on my vaccines to work in the clinic, and what ended up happening is I ended up getting an autoimmune disease, which is a side effect of your RNA. When your RNA thinks there's a problem in your body, and the autoimmune is when it's actually attacking your body, thinking something in your body is okay. This left me paralyzed, essentially from the neck down, for a couple of weeks of my life. And Seth remembers this period of my life well, since we were college roommates. And it was a very scary, very crazy time. And vaccines are not all perfect, and that's for some people they have potential probabilities of having issues with them. Now, if autoimmune's run in your family, it's highly likely you could have that, and that's what happened in my circumstance. But what's interesting about this, and what's kind of a little scary and has brought my attention to a lot of this vaccine conversation, is simply this. Vaccines normally expose your body to a weakened or inactive version of a virus, and that therefore then normally triggers your immune system to learn from that virus, and then ultimately those antibodies are in your body, and when they actually experience the real live virus, they then are now ready to fight it. And what's different about this, so now your mRNA is what makes these antibodies. This is how your mRNA is producing all of this to help fight your body. And I am not a doctor. I'm not a scientist. But what they've done is they have not been able to create a exposure related cure here in the vaccine. What they've had to do is actually say, hey, we can't teach the mRNA how to respond, so we're going to change your mRNA so that it knows what to do without having ever done it before. And so this is a very first time, this is epic in its own nature and so forth. Now, the problem with this is that when you screw around with your mRNA and it doesn't work right, you get autoimmune diseases. That's what happens. And there have been, in a number of articles I've read outside of this, there have been a number of people who have had transverse myelitis, which was actually the illness that I had. And I am thankful to be virtually cured from that. The complexity here is that we don't have historical information. So it's not surprising to me that even though these things have become, highly effective, there are 5% of people potentially going to be hurt from this. Now,
or what about the children that get vaccinated? Or the younger population, and are there issues there potentially with reproductive systems or anything along those lines?
We don't know. I mean, we really don't know. We don't have any historical data because we've never had an mRNA vaccine before. Now, we have a lot of data on things, and I have my own opinion on vaccines because I've been hurt by one or a few of them, but there's a lot of controversy around this, and the controversy stems to the growth that the polling shows that half of America is not interested in getting this vaccine. That's 150 million Americans, 160 million Americans.
And South Korea says, yeah, we'll wait until the price is right. So it's a whole country that's just motivated by the cost.
Yeah, and I think that has to do with the fact that the death toll has dropped so significantly. And we can get, they're finding better ways to deal with this and address this and so forth. So there are people that want to do this, and that's their choice. It's their body, their choice. I think you also have their body, my body, my choice. I don't need to take it. Some states are looking to mandate this. I think that's, completely against our rights. And I honestly would never get a vaccine. I've been told not to. My body is just too, my chemistry, my makeup, whatever, is just too vulnerable to take that chance. And that's why we need to give people the rights to do this stuff. It's a scary world with these vaccines, but at the same time, they've probably saved a lot and helped a lot of people. I don't really know, but you start reading into this stuff, it gets a little scary. And having been a recipient of it, I'm not so much in the conspiracy theory around that stuff, knowing what it can do to somebody. But I also don't think kids need to get it. I mean, I was reading an article too the other day that, in California, only 2 kids under the age of 18 for this entire time have died from corona, listed as corona. 2. It's not 2 per day. It's not 2 last month. It's entirely 2 out of the entire state of California. And that is tragic and horrible that those 2 people lost their lives. But at the same time, that's a lot less than the 5% ineffective rate of the vaccine.
Oh, there's just a giant rabbit hole over there waiting for us to dive into if we were to do a comparison of how many children died from the flu the year before in California, et cetera, et cetera.
Right.
It just goes.
Exactly. And I think that's something each family needs to choose for themselves. But, if you're very concerned and you're highly potentially vulnerable in this area, this is going to be an area you want to go. And there's 160 million Americans that do want this. So, and I think this is great positivity for us to get our markets and our world going and so forth. So that's what I have to say.
On the market side, right? Huge upswing in these companies is one of the things that we saw. A lot of trading volume coming in, pushing those prices higher, and sure enough, 3 days of trading volume out, people taking profits from those as well. Expect some market movement, and one of the things that's been interesting to see is that the momentum traders, which is it's a style of trading that we're going to actually talk a little bit about today, and that has been affected as well. So momentum traders haven't done as well because some of the things that have been pushing the market are just uncharacteristic of those types of styles. And so you might think that this is the solve and everything gets put back into place and away we go. But we're going to talk about what are some of the differences of this period moving through Corona and an economy getting back on track. And what is the market possibly going to look like? Hey, you are listening to Money on Tap. That's going to do it for us at Money in the News. Guess what we're going to talk about, Ben?
I have no idea.
You said it 5 minutes ago, so I'm glad to hear that. Yeah, we're going to talk about understanding the market, right? Small, mid, large, all caps include the market. Styles include the types of trading, passive, active, tactical. What's in your portfolio? We'll be right back. You're listening to Money on Tap.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
More Money on Tap in just a moment. In this Cliff Notes edition of Money on Tap, Ben and Seth talk monopolies.
All of your favorite household names today have been dwindled down to 4, which are Amazon, Facebook, Alphabet, and that's Google, folks, and Apple. Well, they are in the process of being disclosed or uncovered as monopolies.
Yeah, the government's subpoenaing them, and they want them to start talking.
Yeah, and this is an article by Ryan Tracy, Wall Street Journal again, folks. Democratic-led report concludes after 16-month probe that Amazon, Facebook, Google, and Apple stifle competition. Facebook and Google are basically monopoly powers, according to the report, and Apple and Amazon have significant and durable market power. And and they seem like they're splitting hairs in the differentiation here.
Yeah, Seth, break that out for us.
Monopolies, if you take a look at the history of monopolies and the antitrust laws that we have here in the U.S., where railroads were a monopoly at a point in time, and Ma Bell and the telephone companies were monopolies. And what they had to do in the process of creating competition and fairness was break them up. And so that's where you got all the Southern Bell and all these different phone companies that happened. And it's been a consideration recently when you've seen some of the cell phone companies coming together like T-Mobile and Sprint in a merger. Are they basically creating a size and scale that eliminates competition and creates an environment where they can set the price and control profits and can basically squash the ability of another company to operate or do business in that same space?
Yeah, I mean, what's really interesting, Seth, is that it's not just like, hey, we have one and we need two. The perspective is it's very much just the opinion, essentially, of the government on what is a monopoly and when it occurs. Like, if we only had 3 cell phone providers in the country, they could theoretically gang up against all Americans and charge something within range. Or is there enough companies that someone's biting for more business and therefore is going to become competitive? So it's not just we need 2 or 3, it's whether or not it creates enough rigidity in the market that one company's fighting for someone else's business.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in 3-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Ben and Seth.
Welcome back. You are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today, we're talking about understanding the market, the small, the large, the mid, all of these caps. What does it even mean? How many different kinds of styles of trading is there out there, or participation is there out there? And, just so you know, we're not necessarily here to advocate that you invest like this today, right? This is just us having some fun, talking about different things that we get an opportunity to do in our practice and work with our clients on through their retirement goals, whatever that might be. We're here to have some fun with you today. Hopefully you're able to take away some things that you didn't know before, and you can have some fun at the water cooler. And I wonder where is the water cooler today? Because we're in the middle of shutdowns. Who's out there at the water cooler? Tell us. What are the conversations that you're having? We'd love to participate with you. So to get us started, we're going to talk about the S&P 500. Why not? It's the biggest, it's the baddest, it's the most well-known, it's the indice out there that represents 80% of the U.S. market, folks.
You know, the S&P 500, Seth, is absolutely the number one thing that most investors, whether you're professional or not, are looking at. I would say that the S&P 500 is absolutely a better indicator of what's going on in the market than the Dow, but the S&P could be down and the Dow's up, and everyone will say in the general public, hey, the market did good today. Not necessarily the case, So when you look at 80% of the market all being wrapped up into the S&P 500 of the U.S. market space, that's a big chunk, right? I mean, that's a big chunk, and then on top of it, it's a market weighted asset so you have to be a big boy to even get in. Like, right, this is large cap. These are the big companies that we need to drive through this to say, hey, this is what's going to be in the S&P.
Yeah, so let's talk about that. Where does this S&P 500 come from? Right? It's been with us for over 90 years, and it started out with is that right, Ben? Did I get my timeline?
Yeah, 1928, I think it started.
Oh man, that's a while ago. Started maybe it was 90 stocks. Was it 90 stocks that it started out with?
1928, it started out with 90 stocks.
That's the 90. Thank you. We got 90 in there somewhere. 1950, it was 500. And today we're at roughly, believe it or not, it's like 505, if you wanted to take a look at the exact measure of that. And these are not in the S&P 500. These are not small companies, not small at all. We have a composite that is pulled together. So what's the methodology here? How do we even get these 500 in here? All right. So you've got to have a lot of money moving, 8.2 billion or greater. All right. And you have to be able to be liquid, meaning you can trade, minimum of 250,000 shares. And it can't be primarily owned by primarily. I mean, you can't have 75% of the company owned by one person. It has to be at least 50 or 49% of the company has to be publicly traded, and that's what they call public float. So that's how you get. Oh, by the way, to get in, you have to have showed profitability over the last, 6 months, 12 months?
Yeah. Yep. I mean, you basically, the public float. Well, what's interesting about the public float that you just mentioned, Seth, was that, it has to be 4.1 billion. So that means that the amount of shares that you have outstanding have to equal 4.1 billion in US dollars. That's really, really important. Basically, it's not everything in the world that you can invest in the U.S. Like, for instance, they'll include REITs, which are real estate investment trusts that, trade on the exchange, but they won't include ETFs and ADRs and all sorts of different types of other securities. They're completely ineligible. So this is like legit companies that you're potentially going to know. And, Seth, probably what I would want to do is jump in really quick here with, and if you're okay with it, I just like to list the top 10 companies in the S&P 500. You all right with that?
I'm good with that.
Yeah. So, because this is the thing that people need to understand. We did a show a while back on the S&P 500. We talked a little bit about how the SPY or all the different, ETFs or investments that you can do to mirror the S&P 500 are kind of overweighted in different assets because they're market weighted comparatively. But the top 10 constituents by index weight are Apple, Microsoft, Amazon, Facebook, Alphabet A and C, which is Google, Berkshire Hathaway, Johnson & Johnson, Procter & Gamble, and NVIDIA. Now, I don't know if you've heard of any of those, Seth, but those are all companies in the United States. So,
yes.
And Apple is not a fruit. Apple's not a fruit company either.
And Alphabet isn't a soup company. I don't know why that.
Yeah, no, it's not soup either. But this is the big boys, folks. This is where you're getting into. And these are the top 10. And when you buy the S&P 500, and we talked about this in the past, you're going to find that usually the top 25% of the investing percentages are in the top 10 holdings, which are probably going to include all of these right here. Very interesting.
Yeah. So there's something that I came across here. This is it's A to Z investments.com. And I didn't even realize how old this website is. It's like some of the information is still good and valid, but as I look through here, it says 10 companies make up about 24% of the S&P 500 market cap, which is still true today, right? That's what we just talked about. That's the bulk of, and that's what market cap is. That's how this is weighted. Is about 25% is the companies that we just talked about or Ben just mentioned. But this says that they're GE, Microsoft, Exxon, Pfizer, Citigroup, Walmart, AOL, Time Warner, Intel, AIG, and IBM.
Wow.
Yeah, so I looked at that. I was like, holy cow, whose website is this, and why have they not updated this? Or because I want to say that takes us back to maybe 2008. Yeah.
Wow, that's pretty crazy. Seth, one of the things about the S&P that a lot of people don't realize is that the S&P, they do a number of different indices, right? And we talked about how we talk about investments, and I was mentioning earlier that I had made a presentation this last month in person, which was definitely cool to be around people. But we talk about investments, and when you usually sit down with your 401k or retirement person, you're talking about things called small, mid, and large, and they usually have a cap associated with them: small cap, mid cap, large cap, and usually that's a mutual fund type of holding and so forth. Well, it's really referring to the size of the companies. And small cap are really the smaller size companies in the U.S. The mid cap are going to be mid size, and then the large cap is this, 8.2 billion or greater. But I think it's really interesting that we define what people are buying into, because a lot of the investing strategies that we talk about are, where is the money going? How is the money being spent? You don't want to buy something that everyone's selling. You want to buy what people haven't bought yet that know they need to buy it. They don't know yet. What's interesting is that we all kind of have this general understanding, and if you don't, you're going to get this if you talk to somebody. But small cap, it's just the higher risk play. It's the smaller companies. They're more vulnerable than say, an Apple or a Johnson & Johnson, right? And so when you talk about the small cap, the S&P has an indice for the small cap, and that's called the S&P 600, okay? The S&P 600 is basically, or the small cap companies are basically from $600 million to about $2.4 billion, okay, in an unadjusted market cap. So we're talking about, I mean, these are not mom and pops, shops down the road. These are sizable. A $600 million company is nothing to shake a stick at. That's a very large company. Their public float, we talked about earlier, was a stock. The amount of stock that they have out there floating is about $300 million. And they've, we talked about financial viability. They must have a positive financial viability over the recent quarter, as well as over the most recent 4 quarters, all summed up together. And that's an important fact. That kind of runs through all of these areas. But Seth, Seth and I were talking about this offline. We're kind of going through it because, there's a lot of companies you're not going to know in the small cap sector. But there are a few that just are going to stand out to just about everybody, right? And the first one that comes to mind is Crocs, right? The shoe company, right? Those little shoes with the holes in them. I mean, kind of everybody in the United States knows what Crocs are. The other thing is like, what about Yeti? Like, you ever get a Yeti cup? Like, I don't have a Yeti cup in my hand right now. It's some third-party branded similar kind of thing, but I have that right here at right at my desk. I'm looking at it. But
does it say Brayshaw Financial Group on it?
It doesn't. Oh. It has another sponsor company that. I don't know if I'm even allowed to say their name, so I'm going to leave that out. But Yeti is a great company that we all kind of get, but we kind of understand that Yeti came out with it. And then there's a bunch of third party companies that make the same stuff, and then they but that's a small cap company. Mm-hmm. Now Stamps.com is on there as well,
right?
But the other 7 to 10, this other 7 of the 10 top constituents, probably nobody knows who they are for the most part, unless you have some specific association to it. Kind of interesting.
It is. One of the other things I think that's really interesting here is if you take a look at, and we haven't even really started to talk about sectors, right? Because there's 11 sectors in the S&P 500, and those are the same. There's no difference in sectors from one indice to the next, which there's the S&P 600, there's the 400, which is the mid cap, there's the 500, which is we've talked about as your large cap, and then neither one of those have any crossover. But within the indice, there's 11 sectors. And if we were to take a look here at the S&P 500 breakdown, the largest sector, and I'm bouncing around here a little bit, Ben, so forgive me, but the largest sector of the S&P 500 is information technology. And that's, what 7 of the 10 that Ben was mentioning out of the top 10 holdings in the S&P 500 are your Alphabet, which is Google, Apple, right? Microsoft. Information technology. 27% of the indice is owned in that sector. If you take a look at that small cap that Ben was just talking about with Crocs and Yeti, a bunch of other names where we don't even know. 17.5% largest sectors in this are industrials, 17.5%, and financials, 17.5%. What does that tell us in terms of where have we come from and where are we at right now? And some of the headlines that we talk about as well, which is possibly, monopolies in the tech sector and information technology. It is a massive growth segment of our economy and mover in our economy. What has happened here with our pandemic as well? Historically, as we've looked into what has made sense when there's a recession, what kind of investing makes sense for a portfolio to try to preserve assets and perform better over time. Well, historically, that would have been your and possibly energy or utilities. or
Yeah.
industrials.
Yeah, that was a kind of a mainstay to what people went into. I mean, I have people who have like, my dad passed on this energy company, this utility company to me many, many years ago, and I don't want to sell it. It's funny when you look at the sectors, and there's 11 sectors. Seth, I really don't consider real estate. I don't think real estate should be in the S&P. I really don't. I've always thought that. I think it should be 10 sectors. Real estate's kind of its own. It's kind of its own offshoot. Like they should pull
really
that.
is.
They should pull that out. But that's a personal opinion. But when you think about the market cap of utilities, which was kind of a staple kind of program to invest in, and something I like a lot, it's only $1.5 trillion, $1.6 trillion market cap. But when you look at the IT, the information technology market cap, we're looking at over $12 trillion. I would rather see them dump real estate and break the information technology space out a little bit, because because people would weight things differently. I think you've got semiconductors, you've got software. You've got communications equipment, electronic equipment. The IT services world. The semiconductor space is $2.6 trillion. Okay, the software space is $4 trillion. The software alone is a third of the IT space. Like, I would like to see them break this out into a couple different areas and then look at the different sector weightings. I think that would be healthier than us, even though it is all technology, on some level. But honestly, I could say that with almost anything. You could go to communication services and you look at entertainment, or interactive media services. Why isn't that in IT? You know what I mean? Like, there's so much technology around all of the things that we use today that I really think they should break that out.
You bring up a really interesting idea there, and I've never thought of that, Ben. I think that's a great idea, because this has gotten so large in terms of how much does it cover, that there's now all these different areas that have grown into their own domiciles that they have to have this narrative around them that would possibly equal a different sector. So as the economy pulls back and we hit a recession this 2020, the stuff that used to make sense back in 2008 and 2000, as far as what's going to pull us out or where to put your money, it didn't work that way this time. We've completely turned a new leaf. And I think that's where what you were talking about makes a lot of sense, where information technology has and is continuing to pull us out of this recession. It is a huge difference and a huge dynamic moving through the economy. In terms of how has this changed, and we have to go back a little bit to really understand, I think, how much information technology has not only changed the index, but our lives as well. If you go back and take a look at the 90s, IT was just 10% of the index. By 2000, a decade later, it was 30%. And then we hit the tech boom. So we're not quite there yet in the S&P 500. We're hovering around 27%. That is a good indication for us of how things are going to continue to work moving forward, I think. And that's one of the considerations to think about as you're, hey, I want to be in the market. I want to be an investor. Or you've got your 401k and you've got your ETF or your mutual fund that you've bought into the broader market, and they call it whatever they call it, right? That's pretty much what they're trying to mirror here is some kind of a representation of the S&P 500. That's really what it is that you're investing into and should understand about it.
So as we go into less theory and more information that people really care about, because we could talk about the theory of the index forever, and I love that. I love doing that myself, but I don't think our listeners are going to be too excited about it. Seth, I want to jump into, we've talked about the small cap.
Oh, yeah.
We've talked about the large cap, and then you got this mid cap. In this mid cap space, probably less apparent from it's definitely the big boys. Okay, you're not talking about small inconsequential companies. You're talking about a company who has a market cap of about $2.4 billion to $8.2 billion. So, you're kind of all over the place a little bit here. But when you go down to the top 10, there's just not as many companies that are just going to be popping out to you as who the big players are, because the mid cap usually feeds into a lot of the other pieces around around the play. You know, top 10, the number 2 that come up to me, Seth, as being ones that I know of, you know, Generac Holdings. You know, those are the generators that we talk about. You know, that I have a Generac generator myself, and then Monolithic Power Systems. I mean, those are kind of the 2. FactSet's another one, but I mean, Solar Edge Technologies. But there's not a lot here that are going to be like common everyday household names, right? This is not Crocs. This is not Stamps.com. These are
kind of interesting that it's not, though, right?
Well, yeah, I know it is in some ways, but
it's kind of the middle child syndrome.
Oh, that's tough. That's tough. Wow, that was a low blow, Seth.
That was a little rough, wasn't it?
It was. It was. I think this is the thing, though. You know, the whether you're investing in large, mid, or small cap, you have to understand the risk that you're buying. And that's really it, right? I mean, Crocs will come and go. Eventually people won't be wearing Crocs anymore. How are they going to evolve? How are they going to maintain? So that's kind of that understanding risk of what you're going to have going forward. Now, they could evolve and become bigger, and it just becomes the shoe of the next generation. But at some point in time, it's no longer a staple. It's not the semiconductor components that have to be in the laptop or the cell phone that everyone's buying all the time. It's not a need-based item. Shoes are a need-based item, but they're not the only shoe provider. And that's kind of the intrinsic risk we want people to understand when they're getting into the small cap world. Any one of these could be going under, as well as a large company can go under. I mean, you can think of Enron. I mean, look at Enron. That was a large cap company. And boom, they're gone. So, yeah, fraud can happen. Those are things you have to be careful of, too.
So there's more volatility, right? There's faster movement with a mid cap and a small cap versus that large cap. It's just kind of like steering the ship, right? It's how fast can you get your frigate to because I sail frigates to move. Versus the aircraft carrier. Oh, that was horrible. So the sectors of the mid cap space that are dominant, again, this is industrials that really carries the majority of it with around 18%. And then you do get the information technology back into play in the sectors. But the next one really close there, around 15%, is consumer discretionary. And so it is interesting to take a look at what are the sectors in terms of these caps, capital market capitalizations that are predominant, right? And the mega caps now are where we move towards with the the top companies out of the S&P 500, which are those 10 that Ben talked about NVIDIA now. And I think it's interesting to see NVIDIA.
Seth, I'm excited to come back to that in a second. I'm also excited to come back to how is this going to apply to your portfolio and how investing is going to change for you as you move forward. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Stay with us. We'll be right back.
Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about understanding the market, small cap, large cap, mid cap. What does it mean to your portfolio? And, we've kind of just had fun kind of pulling it apart and talking about the, sector weighting. How has it changed? What are these areas? So why? Why are these things even important to you? If you are an investor, it's important to understand, for one, there's risk. What is risk involved? Small cap's going to be more risk. Mid cap's going to be less risk than small cap, but still an asset class that is considered at risk just because it moves a lot more quickly than the larger cap. And I used a horrible illustration of a frigate. I don't know where that came from, but it was a big, it's a ship versus a small ship versus big ship turning.
Well,
right?
Seth, if we go back 50 years, you're really going to nail it with somebody who's listening. They're going to get it. That's fine. Seth, there's one thing here. I'm sorry. That was funny. There's one thing here we're not talking about inside small, mid, and large. And so we have that disparity there. I think we've made that clear enough. We also have growth and value. And the growth assets are usually stocks which don't pay income. And the value stocks traditionally are the ones that do pay you a dividend or income over a period of time. And so now some companies will make special dividend distributions and stuff like that. And so they'll still be classified as growth or whatever. But in reality, there's just a disparity in each one of those sectors of growth and value. And it's interesting because we've done value plays in the small cap that have been tremendously successful in portfolios at times. And we've also gone growth plays. But, we've talked about this on the show 1,000 times, I think, at this point. How we understand the markets in a different perspective than probably the traditional investor who tells you, the advisor that says, buy small, buy mid, buy large, and buy them in various percentages to create diversity in your portfolio. And generally, that makes sense because the history of the market has been investing that way with the baby boomers moving through time, and that's how the market has worked. And no one's going to fault you if you do that. And we do include those sectors in a lot of our managed portfolios at different disparities. But I would say that what makes us unique or makes us different is that we actually slant our portfolios more to a large cap sector, a large cap weighting sector. And we honestly look at some of the value plays inside these sectors because we know that the world is changing. And we all know that the world is changing because we're watching baby boomers retire every day. And we've talked about this on the show. And we know that when you're retiring, you want less risk. And you're retiring, you want less risk, and you want income. And we believe that, kind of this large cap space, because it's considered lower risk, will probably have less of a reduction of asset holding just by the people who are retiring. Now, we're not talking about a few million people retiring. We're talking about the fact that we have about 12 to 15% of America retired right now, which is 35 plus million people out of 320-ish million people. And in the next 20 years, we're going to have 85 million more people retiring. That's in addition to the 35. That's 120 million Americans. That's over a third of our country is going to be retired in 20 years. And all of those people are going to be looking for a different vehicle. Just like Lee Iacocca kept making different vehicles for the baby boomers as they went through, they're going to be looking for different investment vehicles as they're going through their time. And I really think that you can take less risk and potentially make more money. And even though the bond sector is not great with the yields right now, it's still potentially more attractive than somebody who wants to take the risk in the market.
Great stuff. We have changes coming to you, folks. So we just got the news this week that Tesla is going to be moving into the S&P 500 come December 21st. Now, we don't know who's going to be moving out, all right? But why is this such big news as we've been talking about different stuff going on? Because I could tell you last month that, what was their name? Ticker VNT, Vontier, right? Joined the S&P 500 and Noble Energy moved out. And the month before that, it was Etsy. We've heard about Etsy. And have you heard about Teradyne or Catalent? they joined the S&P 500, but nobody, this was not front page. We didn't bring you a show because these were the changes going on in the S&P 500. Today, one of the things that was a catalyst for us, though, was the movement of Tesla. And so this is interesting for us because, A, it is big news. Tesla, in terms of its market cap, is one of the things that's significant here for you to know, is quite large. Those top 10 that Ben was talking about in the beginning of the show around the S&P 500, well, guess what? I think NVIDIA is probably going to have to move out, and they're going to have to make a lot of room here for Tesla because it is so large. Well, why? Why is it not a part of the S&P 500 yet?
I know.
Right?
Well, that was the thing. Elon Musk was pretty ticked about that whole event and so forth because Tesla's huge. I mean, Tesla's, remember we said there was $8.2 billion to be a large cap asset? Well, Tesla's worth $387 billion in market cap. Okay, so this, the kind of the qualification to like just make it in, it's not like they just crossed the threshold. They had a couple different things that they had to have. They had to have profitability numbers and so forth, and there's all these different pieces. And they all had to come in line with what we talked about earlier. And so Elon Musk was mad it didn't happen 3 or 4 months ago because he thought it was supposed to, and they still were waiting for some things to happen just to make sure that they met all the criteria. But think about this. Did you know that Tesla is larger than Toyota, Disney, and Coca-Cola for market cap?
No, I did not. I did know that it is incredibly speculative. It is a growth stock because it has not come through consistently enough with those earnings or the valuations based off of what the real asset is of Tesla. Its real asset is its disruptive technology. It has this product line, this future product line that it's been promising. It's starting to look like it's taking shape around batteries. There's so much about Tesla that we're just haven't quite caught up to. And when I think of that, I think of Amazon, right?
Yeah.
And it wasn't that long ago that people were like, "Oh, it's not a profitable company. I would never put my money into that." And it was $112 a share. So, not that that's what is going to happen with Tesla, but I think that's a lot of the framework here that people are starting to work from. Incredible.
Yeah, and I think as we continue to watch the evolution of companies, we're going to see these indices move, and it's hard because you can't really say the indice of, whatever 90 years ago is not the indice of today. And we see our economy growing, we see the market changing, and so forth. And what we usually advise people to do is to look at it as a gargantuan whole and try to at least take advantage of the upsides and reduce your risk. It's not about being the guy who owns the number one stock and buying Tesla at, when it first came out, knowing that's the one you have to own. It's about participating in the gains because, bringing success is really the most important thing to investing. It's not about taking such high risks that you're either going to win or lose, because lose can't be part of the equation for you long term. You have to find success. And that's what I, and Seth truly believe each day needs to happen for people, is trying to find that success for them. And it also doesn't necessarily mean that the stock market needs to be, a major portion of that or any portion of that, depending on what your goals, your needs, and what you're trying to accomplish is.
Hey, a lot of fun today. Thanks a lot for sticking around with us. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, we are financial planners first and foremost. We have a lot of fun doing this show with you. And we do appreciate all of the comments and all of the likes and the listens. If you happen to be at a place in time where you have retirement as a goal for you and you haven't quite found what that's going to look like, or what does risk look like? How do we put this idea together and create a successful retirement? That's what Ben and I do on a daily basis. That's what we're passionate about for our clients. And we love the opportunity to work with you. Give us a call, 855-226-8551 or info@yourmoneyontap.com. Make it a great week, folks.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.